On the podcast with us today is Zach Haptonstall. Zach, welcome to the podcast.
Hey, thanks, Dan. Appreciate you having me on, man. I'm excited for the opportunity to be on the show.
Well, it sounds like you guys are on fire and closing several deals this month. This is August 2019, and looking forward to diving into one of these, the 137-unit one called Villa Serena, located in Phoenix, Arizona. But before we dive into that property, I want you to give the listeners a little bit of a background about who you are and where you are right now in the multifamily space.
Yeah, sure. Yeah, so quick background on me, Dan. So I was born and raised here in Phoenix, Arizona. Lived here my entire life. Lived in Colorado for a bit on a football scholarship. Realized I wasn't going to make the NFL, so came back to Phoenix, and I wanted to be a sports reporter. So I got a journalism degree from Arizona State, and I was actually a live news anchor and a sports reporter for Arizona PBS. And I hosted a show on Fox Sports Network Arizona here for about 5-6 months, which was cool at first. And then I quickly realized you don't make any money doing that. You work crazy hours, very political. So I realized I want to do journalism. And so at the time I was delivering medical equipment nights and weekends to pay for school. My boss at the time was like, hey man, you can make good money doing healthcare marketing. So I had just gotten this journalism degree, had all the student debt, and I actually decided to go into hospice sales. So I don't know if you're familiar with what hospice care is by chance, Dan, but basically like end of life care, mobile nursing, caregiving for patients. So anyways, my job is just drive all around Phoenix here and cold call, walk into like hospitals, doctors' offices, assisted livings, and build relationships with physicians, social workers, nurses. And they had a patient needed hospice care. They call me. I'd come meet with the patient, family, educate them, get them signed up. So anyways, it sounds kind of weird, but hospice is actually an extremely competitive and lucrative private business industry. So I was fortunate to do well in this hospice industry. I became the director of marketing, and then I became an owner in the company. And so coming from like a lower middle class family, I was blessed to be making like $200K plus a year at a young age. Got my MBA, bought a house, paid off all my debt. So I was in good shape and fortunate, but I just got burnt out. I was working 60, 70 hours a week doing something I wasn't passionate about anymore, getting taxed heavily. So last year, January of 2018, I said, screw it. I don't want to do this anymore. I don't know what I want to do, but I don't have any time to figure it out. So I resigned and I sold my equity in the company in January of 2018 with no plan at all. I just knew I wanted to create passive income somehow. And so I knew I wanted to do it with real estate, but I didn't know anybody in real estate. I don't have like a rich uncle or anything like that. I didn't know anybody in multifamily specifically. So kind of as the cliche story goes, I read Rich Dad, Poor Dad. That kind of helped change my mindset. I just started to consume all these books and podcasts, just people like you, Dan, who really provide value so I can learn about these things. And I had decided I'm going to live off savings for 12 months. So my fiance and I, Grace, she has a job, but we decided let's reduce our expenses significantly and live off savings. So I had dedicated 12 months to figure out how to create passive income. And I wasn't thinking multifamily necessarily. I was just trying to learn however I could. I didn't know what I was doing. And so I was originally looking at mobile home parks. And so I cold called over 90 mobile home park owners here in Phoenix. And I tried to buy one on a seller carry. It didn't work out. I then started to learn about multifamily and syndication. I realized I need to really focus in and hone in on that. And because a lot of my network was made up of like physicians, healthcare business owners from my hospice care work, I thought that would be an intriguing thing to do syndication, because a lot of these people in healthcare also hate their lives, Dan. They don't have any time. But they have money and they want to put it somewhere. So I was like, I need to learn how to do this. So long story short, I went like literally 9-10 months of trying to figure this thing out. And we finally found a 36-unit deal in October of 2018 last year that penciled. And we put an offer in. We were scared when it got accepted. We didn't know what to do, and we figured it out. So we closed on that. It was a 36-unit, $3.4 million deal. We actually did a tenant in common structure, a TIC on that deal. And then we were just fortunate to catch some momentum after that. And we acquired a portfolio of 2 more deals, a 76-unit in Phoenix, which we did like a traditional 506B syndication on, and then a 59-unit deal in Scottsdale, which we did another tenant in common TIC structure. And then we just closed on a larger property, 137-unit deal. So basically, it's really been about 18 to 20 months or so since I had quit the W-2 and decided to focus on multifamily. So it's just really a mind shift. That's kind of how we got into where we're at now.
Well, it's really kind of exciting to kind of see somebody like that has really just kind of said, I'm going to burn the bridges and just kind of go full force into this. And even at the time, you didn't even know what you were going to be doing, but then making the decision to go full force with this and just kind of seeing where it's taken you up until today. So let's dive a little bit further into this property, which is the Villa Serena. the 137 unit property located in Phoenix, Arizona. And so this would be your fourth deal. Is that correct?
Correct. Yep, that's right.
And so I want to talk to you about a couple of different things on this, but I want you to first talk to us about how you sourced this deal and found it.
Yeah, so this deal, along with all of our deals, have been on the market, Dan. And so, I mean, Phoenix is an incredibly competitive, overheated market, just like anywhere in the country. And as you know, it's like finding a needle in a haystack. So we're cranking underwriting. Every deal that meets our criteria that hits the market, we'll underwrite it and give the broker feedback. So this was an on-market deal, and it was surprising when it first came to market. We underwrote it, it penciled, and we're like, crap, did we do something wrong here? Because usually it's not even close, especially in Phoenix here. You know what I mean? There's very compressed cap rates, but the deal penciled, and so we really started to just dive in deeper. Got the pro forma from our property management company, started to shop comps, and we're able to make the deal make sense.
So how many had you this broker, they brought you this deal, had you already purchased a deal from them in the past, or was this a newer relationship?
This was a new relationship. I had never met this broker. I had heard of him, and he had heard of me. I host a monthly meetup here in Phoenix Multifamily Meetup. So I had one of his junior brokers on our speaking panel a couple months prior, and so we kind of had heard of each other, but had never really spoken. So this was an on-market deal. Never met the broker. No relationship in place.
Okay. And how long had you been building that relationship?
With this broker, like I said, I had never met him. I mean, I knew the junior broker for maybe a few months or so. And so I think he knew that we had executed on at least one deal, and he knew that we had a couple other deals that were closing soon. And so I think, as you know, in multifamily, word kind of spreads quick. And so, but granted, we didn't have a relationship or reputation with him. So we felt that we had to win the deal on terms as well. And I think that our terms were a big part of why we were able to be successful.
And so how many rounds of offers did you go out through on this property?
So there was an initial call for offers date. We put in our offers. And then there was a best and final, which was really the final five. There was a final five. And then after that, they did a final three. So I guess you could say there's 3 rounds after that first offer date. The final 3, they did interviews. The seller interviewed the buyer group. So we were in that final 3, and we were fortunate to do well in the interview. We won it from there. Okay.
And what do you think it was that made your group stand out from those other 2 groups, and that when you got down to the last 3?
Yeah, I mean, and that's a good question, Dan. And I think it's really important is that, like you mentioned, having a relationship with the broker. I didn't have a pre-existing relationship with the broker, but I was really trying to cultivate that relationship throughout this process, throughout this 4-week process of putting in offers. And I was trying to really dig into him and get some information. And when we got into that final 3, I asked him, I said, okay, Mr. Broker, where are we in ranking on purchase price? Where are we on terms? Where are we on hard money, day one? Where are we on track record? Things like that. And so, I mean, to his credit, unfortunately for us, he was pretty transparent about that. He said, you're second in this category, you're third in this category, you're first in this category. And so, I mean, as you know, some of these deals are crazy, especially this was a little over $17.5 million deal. And so you've got more competitive groups. To answer your question directly, Dan, we had $250,000 hard day one with no look. And that was our personal cash. My co-sponsor, our personal cash. And so that money is gone. Basically, we were awarded the deal, execute the PSA within 1 business day, wire $250. And some people are going to say that's crazy, and it is kind of crazy. But the reason we felt comfortable doing that is because our property management company actually had inside information, so to speak, on this deal, meaning that their subcontracting roofer is the same roofer that the seller uses. And so when we're working with our property management company and getting a pro forma on this deal, they're like, hey, you're in luck. We have a full roof inspection from 2 months ago that the seller just completed from this same subcontractor. And they vouched for the roofer, and so they trust this company. So there was a full line item roof inspection, complete with pictures, everything like that. And so we underwrote what it would cost conservatively to completely recoat these roofs, the equivalent of putting brand new roofs on it. These were foam roofs. And then, so we felt good, and the deal still penciled. So basically we pencil that in, and the deal still works. Then I asked the property management company, I say, okay, let's assume the sewers and the plumbing are totally shot, like they're totally destroyed. How much does that cost? They give us the number for that doomsday scenario. We penciled in as contingency, the deal still penciled. Okay, so we felt pretty confident that our biggest liabilities or exposure were the roofs, the sewer, the plumbing, and that we were in good shape to replace all those things if they were indeed shot. And so this was an 80s build, copper plumbing, copper wiring. So we felt confident going 250 hard day one. And then we had a 10-day due diligence after that where we could have backed out, but that 250 is gone regardless. After the 10-day due diligence, it was going to be another $200,000 hard. So after 10 days, we're in for 450 hard. And so I feel like that was a very competitive hard money for a $17.5 million deal. And then we had agreed after that 10-day due diligence to close 45 days thereafter. So from the moment we signed the PSA, we're at a 55-day closing. And then we had the right to exercise two 10-day extensions at $75,000 each. Okay, so that was one big component. And then on the seller interview, I think we did really well in the seller interview. I mean, we demonstrated to the seller our knowledge of the submarket, the comps, our business plan, our ability to perform. And I think that goes a long way. You know what I mean? If you can really demonstrate that you know what you're talking about.
Yeah. One of the things I think that is very important that a lot of people might miss if I don't touch on it here again is the fact that sometimes, sometimes people think, oh, you can't ask the broker certain questions about the other people, right? And a lot of times they're more than willing to share that information, but you just have to ask for it. So, and that's what you did here is you basically just asked the broker and said, hey, where do we sit in these various categories? First, second, third, there's three people in here. You don't have to tell me where they're at. Just tell me where we sit in relation to them. Because a lot of times they're not going to tell you, hey, they're at this number. So if you can get above that, you can do it. But they'll tell you kind of what position you're in. But sometimes, we've even had them tell us where other people are. They won't tell us the number, but I'd say they're about 100,000 higher than you or something.
Yeah, exactly.
So they that guidance. I think it's very, very crucial, especially when you're trying to win a deal like this.
100%, and that's a great point. I mean, I think a lot of people who are not in multifamily, or even those who are in, we think of the brokers as these big, bad, intimidating brokers, right? And their job is to get the highest purchase price for their seller. And are they going to try to bid you up against real or phantom competitors? Yeah, I mean, the competitors may or may not be real, but I mean, that's where you have to kind of really form that relationship and feel them out. I mean, this particular broker, they do a lot of bigger institutional stuff. This is a small deal for them. And what I've noticed, this is just personally, this is probably the most professional and straightforward broker I've worked with, just because I think he's doing a lot of bigger deals and just very transparent with stuff. And so, yeah, they're not going to tell you, like you said, oh, you're $100,000 off, but you have to ask those questions. And if you can kind of put that broker on the spot, I mean, what are they going to do? They could lie to you, but you can try to read them if they're lying. You know what I mean? So they'll be ambiguous, but they can say which ranking you're in. And that goes a long way for you to determine how far you need to push and how you can potentially win a deal.
So prior to putting this property under contract or anything like that, how far into the process after you heard about the property did you go and tour the property?
Yeah, good question. So it was a week later. We saw it hit the market. I reached out to the broker, said, hey, Mr. Broker, I've seen a lot of your properties. Haven't had a chance to meet you yet. Would love to get out there and tour this asset with you. And this is just from the very beginning, Dan. I think it's important. I mean, this is a good example. Like, I've never met this broker, but it's always important to form that first impression and the perceived credibility with these brokers. Like, for me, I always wear a tie to every tour, and that's just my thing. 'Cause I'm a younger guy, you know what I mean? So it's easy to perceive me as not credible. So I always wear a tie, and I'll always review the OM. And even if it's a deal that I'm not even interested in, I'll be taking pictures and act like I have a good knowledge of the property. So basically, the next week, we set up the tour with the broker, and we're working with a very credible property management company here in town. Unfortunately, our regional was not available to tour the asset with us, but I told the broker, I said, hey, our regional needs to get out here as well so we can dial in our CapEx budget and our pro forma budget. Can he come out here next week? And so we were not available to go out there, but our regional actually toured it again next week with the broker, and they knew each other. So that right there kind of formed some credibility too. They said, okay, you're working with this property management company. And I kind of leveraged a relationship that our regional had already with the broker to give us some credibility.
That's great. So now you're in the due diligence process after you get the deal awarded to you. What are some things that maybe came up during the due diligence process that you had to deal with?
Yeah, good question. And one thing I want to touch on too, Dan, is that because we were going 250 hard day one, we wanted to make sure that we had as much protection as possible. And so we requested the phase one environmental report that the seller had gotten when they acquired the property 5 years prior, and they gladly sent that to us before we were under contract, so we could see that there were no major environmental issues. We also requested clean title prior to that point, which they gladly sent over to us. And so we felt pretty good with the title, the environmental prior to going to that point. With the due diligence was honestly, of the 4 assets that I've been a part of going through due diligence. And when we do due diligence, I'm there like all day with our property manager. So I'll go into every single unit, or oftentimes we'll split into 2 teams. So my partner and I, Robert, will be with each team of our property manager company, and we'll do half of the property respectively. But this was a really clean due diligence, and I think it's because we already knew what we were getting into with the roof situation, which was in pretty good condition, but we wanted to budget for it. And so we had our roofers come back out there again, and they just basically reconfirmed what the previous reports had said. We scoped the sewers, everything looked good. Again, this is an 80s product, so it's copper plumbing, copper wiring. And the biggest thing for the inspection was just trying to find out, it's really dialing in your CapEx budget. Because as you know, Dan, you may tour 1 to 3, 1 to 4 units if you're lucky when you're touring a property, but there's no assurance that every unit looks like that. And on this property, we had three separate grades of finishes, like a classic, a mid-grade, and then a platinum. And so you really get an idea of how you can break those things down, and how many units need flooring. So how much do you have to spend on that, et cetera, et cetera. So, I mean, that was the biggest thing for the due diligence, was to dial in our CapEx budget so we can see how many units are like this, how many are like that. But there was no major issues, fortunately. I think one thing we saw was that the fire code restrictions were not completely up to date. So we requested that from the seller, and they took care of it immediately with like fire extinguishers, stuff like that. So fortunately for us, there was no major issues with this property.
Yeah, that's great. So let's talk about the financing on this thing. What did you guys do as far as the financing and the debt?
Yeah. We got a 10-year fixed rate non-recourse Freddie Mac conventional loan, so permanent debt right out of the gates. It was 5 years of interest only, which really helped our cash on cash return for our investors. It's we actually got really lucky. So as you know, Dan, and a lot of people know, Freddie and Fannie had just recently hit their volume limit for what they projected for the year, and we did an index lock. For those of you who don't know, so for a Freddie Mac conventional loan, your rate is floating. However, you can do what's called an index lock, meaning that if you pay 2% good faith deposit, so 2% of the loan amount, in our case, the loan amount was $13.1 million, then you can lock in your interest rate. And so we did our index lock 2 days after the Fed had announced that they were going to be cutting interest rates. And there's not necessarily a direct correlation between the Fed cutting that and the treasuries, but in our case, it did help us. So we locked in a 3.8% interest rate, which was really good. And it actually boosted our returns because we were conservative with underwriting to a 4% based on our term sheet. So 10-year fixed, 5 years of IO, 3.8% interest rate, a little bit over 13.1 million, which was a 75% LTV, so 75% leverage. None of the rehab was financed, so all of our renovation dollars were raised by us, and it was a little bit under a $6 million raise. So it was about a 5.8, almost $5.9 million raise, which was our down payment plus all of our CapEx.
So with the debt, did you have any issues with the lender going through that process?
We did not. Thankfully, that was very seamless. I mean, we used a broker. Our lender was Capital One. We used a broker, Meridian Capital. They were great. We highly recommend working with those guys out of New York. And they got us. Everything was really seamless. And like I said, this was our 4th acquisition, and this was the smoothest one. I mean, there were scary things in some of the other acquisitions. I mean, I've had proceeds get cut by $227K like 3 days before closing. We had to raise that money on the first deal, for example. So we're well aware of all the scary stuff can happen. But on this deal, it was really seamless, and we were just on point for executing all of our lender paperwork, making sure all of our guarantors were completing their stuff as well.
Mm-hmm. And had the guarantors that you used on this particular Freddie Mac loan, had they already had prior experience with Freddie Mac, and there was already a track record there, so it was a little bit easier from that standpoint as well?
Yeah, good question, Dan. And this is actually a point I want to discuss for using as a strategy for a 506c raise. So for us, we had 6 guarantors, which sounds like a lot. We didn't even need that many guarantors. We had a few of them on there simply to get their Freddie experience. So among all the 6 guarantors, it was only myself and one of my other partners who had previously signed on loans that we've done that had Freddie experience. We had guys with we had a couple co-sponsors that had a much higher net worth liquidity than us, but we just didn't need it for this loan. It was kind of weird actually. They only wanted a $5 million net worth requirement for this loan. And the previous loans, they wanted a net worth equal to loan amount and then the first 9 to 12 months of liquidity. But on this deal, just 2 of the 6 guarantors had that previous experience. And for us, we know a lot of people who want to sign on these loans so that they can get their quote unquote Freddie Gold or Fannie Gold card, where they get that experience to do future deals. And so I know in a lot of syndication models, people have to give these guarantors or key principals a part of the GP equity. For us, what we've been seeing is that there's such high demand is that there's actually people who are willing to invest 2 or 3 times the minimum investment amount passively in order to be a guarantor on our deal. You know what I mean? And so for us, it just helps us to raise more capital, and then they can do it that way. And as far as the 506c goes, Dan, I wanted to touch base on that guarantor thing because, as you know, with the 506c, you can actively market the deal, solicit the deal online, whatever, as long as you only take accredited investors and you take reasonable steps to verify that they are accredited. And so the cool thing is about this 506c deal, which we didn't really plan on, but we realized is like a residual effect, is that some of our guarantors, a few of them actually, were not general partners on the deal. Okay, so they're not GPs, they're not in the management LLC, they're not getting any GP equity, but they were just guarantors. Well, basically, this was a good opportunity for them to test their hand on quote unquote raising money. Okay, and I'm not an SEC attorney, so always consult your SEC attorney, but we discussed this with our SEC attorney, and they're not getting compensated. They are not on the GP side, but because it's a 506c, they can tell their friends about the deal. And it allowed us to basically penetrate into other spheres of influence where they're telling their friends, and it's kind of like they're raising money for the deal because we don't have to have a pre-existing relationship with their passive investors because it's a 506c. So that was one of the real values of the C that we saw and leveraging other guarantors.
Mm-hmm. That's great. So now that you brought up the 506c, we're going to be kind of diving into the structure with the investors. So before we dive into some of the nuances around the 506c itself, talk to us about how you structure the deal with the investors as far as like the equity splits and, preferred returns or whatever kind of waterfalls you might have had in place with it.
Sure. Yeah. Good question. And so for this particular deal, it's very simple. There's no preferred return, no waterfalls or anything like that. It's just a straight split. Okay, so we had initially done an 80-20 split where 80% goes to the limited passive investors, 20% goes to the GPs. We changed that slightly, and that was it was an 80-20 with no acquisition fee, no asset management fee, no preferred return, okay? We changed that to an 81-19. The reason being we wanted to use a third-party investor management company. It's called Update Capital, but there's several of them out there, IMS, et cetera, which basically keeps everything organized for communication updates with your investors, and they'll automate issuing the annual K1s, things like that. Well, the cost for this third-party investor management company, you can't underwrite that in the operating expenses of the property, or we didn't anyways, because it's not a property expense. So what we did is we put in a 1% asset management fee. We're using almost all that fee to pay for this third-party company, and we shaved off 1 point of our GP compensation so that the returns were not negatively influenced for the passive investors. Okay, so basically it's an 81-19 straight split. And what that means is that we're projecting 6 months from acquisition is when we'll start to begin the quarterly distributions. And so when we begin those distributions, it's going to be a straight split. We, the GPs, will receive 19% of that cash flow distribution quarterly, and then the passives will receive 81% of their share. So the difference for a lot of people who kind of ask on these two different models, Dan, and I know you've probably done different ways, is like with a straight 80-20, we're getting paid at the same time. So we're getting cash flow distributions, we the GPs, and then we'll get paid that percentage upon a sale. Whereas with the traditional preferred return and waterfall type of method, usually you'll take like an acquisition fee on the GP side. So you're getting paid a transactional fee on the front end, And then you usually don't get paid for most of the hold. It just depends on the asset, but you'll usually get paid on the back end. And that's because the passive investors have that preferred return. So those are kind of the two differences. But we do want to look into doing the pref and the acquisition fee model as well.
No, it's always interesting to kind of see what other groups, how they're modeling things. And that's typically what I've seen as well, where there's, if there's a larger equity split on the share on the promote side for the sponsor team, it's usually because there's a preferred return. So what that does is it actually lowers the risk for the investor, which is why they have that preferred return in there. But it also raises the risk for the sponsor team, because they could get nothing throughout the entire hold period. And, depending on how the deal goes, it could get nothing or could do really well. So
right.
Our group usually does a secondary waterfall structure where, or in the waterfall, we have a secondary hurdle where if we're projecting a certain IRR, if we overachieve and go above that projected IRR, then that actually changes the splits to 50-50 as well. Because again, it doesn't affect the projections and the returns, because it's basically anything over and above what our maximum projection is. Then if we outperform that property, then the sponsorship team gets rewarded for that extra hard work.
Yeah, I like that model, Dan. And for us, we're doing this straight split simply because we're newer, you know what I mean? And we're trying to prove a track record. So like I said, we closed our first deal in February. We've been blessed to have 4 deals now, but by no means am I an expert or we experts. So we're really trying to make sure we do a good job with asset management. But it's just kind of funny because people can argue, they can argue it both ways. You know what I mean? I've heard people argue that, the people who do the acquisition fee model, the sponsors are incentivized by fees and they don't want the property to perform. And I could argue, yeah, they do, because they're not going to get paid until the end. So they do have to have it perform. You know what I mean? And then I've heard people say with the straight 80-20 split with no pref and no acquisition fee, your sponsors are not incentivized because they don't get paid until you start doing cash flow and they make most of their money upon a sale, but they didn't get the acquisition fee to keep them going. So I think that you can make arguments for both models. I think that as we begin to scale and want to acquire more units, simply from like a sustainability perspective, the acquisition fee makes a lot of sense. You know what I mean? Because we only have so much liquidity as GP sponsors. And so you can roll those acquisition fees in as your skin in the game, and it just allows you to live and do other things too. So now that I've been meeting more syndicators like yourself and experiencing myself, I don't think there's any issue doing acquisition fee in the waterfall. I think it makes a lot of sense for all the work and time that goes into being a syndicator and a sponsor. So
diving into the 506C a little bit, how many investors did you end up having to close this deal?
Yeah, so we have 64 passive investors in the deal.
Okay. And how did the process work with the 506C? Like, what did you do that, was beneficial for you to be able to do the 506C? Because obviously, for those of you who are listening that might not know the difference between a 506B and C, the major difference, which is what we're going to dive into, is the ability to bring on investors that you don't have a prior existing relationship with them, and you can now market and publicly advertise your deal. But the only caveat is you cannot take non-accredited investors. You have to only take accredited investors, and they have to be verified by a third party or verified by, there's other ways to do it, but the easiest way is a third party to verify that accreditation status. So talk to us a little bit about how you did that piece of it and what was the major benefit for you.
Yeah, no, it's a good question, Dan, because we didn't necessarily plan to do a 506C. We didn't go into it saying, let's do a 506C. We were just kind of looking at our respective investor databases among the co-sponsors, and it was just kind of like a natural progression. We worked with Mauricio Raul, who's our SEC attorney, and one of us had just asked, we were asking each other, like, how many of your investors in previous deals were accredited? And so 2 of our guys, who are 2 of our more experienced capital raisers, they each said, like, all of them have been 85 to 90% of our 506B syndications were accredited investors. And we had just finished a 506B on a smaller 76-unit deal here in Phoenix. We had finished our raise. We looked at that. It was like 85% were accredited. So for us, that was a $3.7 million raise. This was bigger, obviously, at like a $5.8, $5.9 million raise. So for us, we wanted to do the C because we felt like we could leverage other avenues through the marketing component to basically gain new investors. And so that's why we decided to do it. And it was no additional cost. I think there's a big misconception out there from SEC attorneys that 506C is so expensive to do. It was literally the exact same as doing a 506B cost wise. And so we didn't even know that. We thought it was more expensive till we asked our SEC attorney. And obviously depends who you use. I can't speak for everybody. So we're like, okay, well, this could be cool because we can leverage social media, web presence, the meetup that we have to do these types of events and market the deal. So for us, it was actually a lot of fun because the 506B is like so secretive. You know what I mean? You feel like you can't say anything or you're doing something illegal, which is true. And so not only from that perspective, but the 506C liability wise is just a lot safer legally. You reduce your exposure because, as you know, Dan, if somebody ever questions your 506B syndication and says, hey, you need to prove your substantial relationship with that passive investor, it's up to you, the GP/sponsor, to document that you have a substantive relationship with each individual investor. And so with the C, you don't have all that pressure necessarily. You just need to make sure that you're taking the reasonable steps to verify that they're accredited. So for us, we really like the fact that we could use targeted Facebook ads, targeted LinkedIn ads. These are like paid ads that we did. We did a lot of videos. So a lot of our due diligence was focused on doing drone videos. I got up on the roof and was doing videos for LinkedIn. We were doing interviews of our property management company, things like that. And we did capture investors that we did not know at all, purely from social media, okay? But I will say it was not a high conversion rate. We only spent maybe $1,000 or so on ads, which wasn't a lot, and we realized we should budget more in the future. But yeah, we did definitely capture investors, at least a few $100K that we had no idea who they were. They literally clicked on our link from LinkedIn or Facebook, and then we set up a call and discussed the deal. They verified they're accredited and they invest. So that did help. But the biggest thing, honestly, like I said earlier, was being able to leverage other spheres of influence. Okay, so for example, I had an investor who had just invested previously in the 506B we had done, and he's like, hey, I want to invest in this one too. And so I was like, okay, great. And this gentleman had told me, he's like, hey, he had told me previously, hey, Zach, I want to do smaller deals with you. I can raise capital. I said, okay, well, I'm open to doing that in the future. Well, when this deal came up, I told him, I said, hey, I know that you want to raise capital in the future. And this may be an opportunity for you to kind of test your hand at it. I said, you're not going to be a GP. You're not going to get compensated in any way. But if you believe in this deal and you have friends that want to invest in the deal, and they're accredited, then you're more than welcome to share this deal with them and see if they're interested. And sure enough, he has a friend who reaches out to me. I have an hour-long phone call with the guy, just discuss my background, this market, the business plan, everything like that. And he invests over $200K in the deal. And so that just kind of shows you the power of leveraging other spheres of influence. I mean, another example is, like I had mentioned, I've got some physician passive investors. Well, one of my buddies is a physician. He had invested in a couple of our deals. He invested in this deal, and he tells his friends about it, and a couple of them invested because he invested. And so if you have passive investors who have friends that trust their friends, because if they're putting their money in, then maybe they'll test their hand at it, then you can take these investors as long as they're accredited and you verify that. So that's kind of the advantage of the 506C as opposed to the 506B. And the other quick advantage too, Dan, is just the branding. I mean, obviously, you're like a marketing machine. I see you speaking at all these events. You understand the importance of online marketing. The 506C is cool because you can brand that you're actually doing deals. You know what I mean? And people recognize that. So I can't tell you how many different calls I've set up and people I've met with just because they saw stuff on social media that we were able to meet up with. And then the last point, I know this is a long-winded answer, but I just want to make sure I touch on this too, because this was kind of cool, was that, like I mentioned, we do a monthly multifamily meetup. And each month we have no less than 40 to 60 people show up. Well, for this particular month, which was in July, we decided to use the multifamily meetup as like a dual purpose stage for this deal. So what we did is one of my partners flew in from California, him and Bikram and I, we did a live presentation of the deal. We basically did our webinar over again, but in person with our same webinar slide deck, so that it was like a case study for all the people who were at the meetup, but it also doubled as a marketing opportunity for us to show the deal off. And then we streamed the whole thing on Facebook Live. And so it's kind of cool that not only are we capturing the people that are in the room, but all the people on Facebook Live that watch it, they also see the deal. So there's just different things like that you can do. You can do in-person presentations, social media, the online marketing that really help you benefit from 506C.
Did you have anybody in your local meetup group actually invest in the project?
We had one guy who did it. We had one guy who invested, and he had been to previous meetups, so he kind of knew who we were. So I can't say that it was necessarily like a direct correlation because of that. But I think that if you believe in your deal and you're willing to get in front of a bunch of people and discuss the deal and answer all the questions about your assumptions and your underwriting, it gives people more confidence in it. And so I think it just kind of lends credibility for you. But and one other thing too is that we were going to a conference in Dallas 2 weeks later after our meetup. And I got this idea on a Wednesday. Okay, the conference is going to be Saturday. And I got the idea on a Wednesday. We were going to fly in Friday afternoon. And I told Grace is my fiance. So Grace is like a marketing machine. She does everything online marketing. I don't do any of it. She runs all that stuff. I said, hey, we should do a meetup. We should just set up a meetup in Dallas and just try to get people to show up, and we'll do another presentation about the deal. And so she puts out a link Wednesday afternoon, she calls a restaurant, reserves like a private dining room, sets up an RSVP link. We have over 50 RSVPs, over 40 people show up. We didn't even know most of them, Dan. It was crazy. And we basically agreed with the restaurant that we could bring our own beer and wine. So we go to Total Wine, we buy like a bunch of beer and wine, and we served beer, wine, and appetizers. And we had over 40 people show up. We did another live presentation in person of the deal, and we had at least 5 to 6 people invest from that. That was really the biggest turnout right there. So that definitely was a good translation.
Another little tip that you can use, Zach, for your what did you say her name was?
Grace.
You can tell her this and see what she thinks about it. But we've actually used this in a couple of different other industries, and it's worked fairly well. We haven't tested it yet with the 506C because we've only done one of those in our group. But you can, when you have an event like that, like if it's a multifamily event, there's like 500 to 800 people or whatever, 1,000 people going to an event around multifamily. Yeah. You can actually geo-target ads around that venue and that location. So people who actually traveled to come to that location, you can actually put up an ad on their social media from that. So that they're multifamily investors that are at that venue. You just geo-target them and hit them with that 506C ad.
That's smart. Yeah. So it's like you vetted them beforehand. You've got qualified leads coming.
And you don't even have to be there, right? Because you can do it from events all over the country, just all over the time when you have that deal.
Yeah, no, that's true. That's smart. I like that. Next time. I'll call you next time before our next C.
Yeah. So what other issues can you think of that maybe came up throughout the process that we haven't discussed yet?
Yeah. So, the 506C is a double-edged sword, right? So like I said, social media and all that online stuff, it's cool. Like it's cool to have a deal. But like I said, the reality for us was that it was not a high conversion rate. It's better for your branding, but it doesn't necessarily attract investors. Okay. There were a handful. And it's good to get the spheres of influence. The other side of that is that we had to turn down a lot of sophisticated investors. Okay. There was a lot of sophisticated investors. I was actually surprised how many people wanted to invest in the deal. And I asked them, are you accredited? And they say, no. I say, sorry. If you feel kind of bad, you feel like a jerk. And it's like, well, where were you on my last 506B? It's kind of funny. But we turned down a lot of those sophisticated investors. So that's what you have to remember. You need to kind of look at what your investor database is primarily made up of, and is it worth doing a 506C? I think that's the biggest thing, because you cannot take those non-accredited sophisticated investors. As far as the verification process, I think that's one of the biggest. That's one of the biggest things that holds people back from doing these 506Cs. Because a bunch of people have come up to me at different conferences since we've done this and said, how is the verification? That's why we don't want to do it. It really was not a big deal for us. Our SEC attorney advised us there's 3 ways to do it, 3 primary ways to do it. They only have to choose one, okay? And by ways, this is verifying via third party that they are accredited. Okay, so the SEC attorney creates a template. There's 2 templates. One is to verify that you're accredited via income. One is to verify you're accredited via net worth. You only have to have your CPA. The investor has to have their CPA fill out one of those. Okay, so that's one thing. The CPA fills out a template. The second option is the investor can just send you the last 2 years of W-2s to show that they've met the income test. Then they have to send you an email saying, I reasonably expect to make this much or more this year. Okay, that's the second option. The third option is that the investor can go to a website called verifyinvestor.com, and they fill out some questions, they upload the necessary documents, and that's their third-party accreditation verification. Now, that's about $60 a pop, $60 an investor, which we absorb that cost for the investors. We underwrote it on the front end. However, you can buy them in bulk, so to speak, with verifyinvestor.com. Like if you buy I can't remember what it was. I think if you like 25, it reduces the cost pretty significantly. So we did that. We had like 25 just to do that. So yeah, so it wasn't a big deal, but you do have to make sure that you complete their verification prior to closing. Otherwise, you have to send their money back. And some people are like, well, what do you mean send the money back? You shouldn't have taken their money in the first place. So we straightened this out with our SEC attorney. Basically how it works is they can sign their sign off on the PPM, sign their subscription docs, wire the money, and they need to basically verify this before you, the sponsors, countersign all those documents, because those are not mutually executed official documents until the sponsors sign all those PPMs and subscription documents prior to closing. So you do need to make sure. And we had a bunch of I wouldn't say a bunch. We had a handful of investors the last week. We said, listen, we have a ton of demand for this property. Either you verify you're accredited, or we have to kick you out. You know what I mean? And then that kind of lights a fire under them. So that's the only thing. It wasn't really a big deal, honestly, from our experience on this one deal.
Well, Zach, I want to thank you so much for taking some time to be here with us today and sharing all this good information. I know it's going to be a great episode for a lot of people that are interested in the 506C side of things, as well as a lot of the different nuances surrounding this. So I want to thank you so much for being here. And how can the listeners reach out to you if they want to contact you or discuss some things with you about this asset further?
Yeah, no, thanks, Dan, for having me. I really appreciate it. You can just feel free to shoot me a text and we can set up a call. I'm always available to talk and help however I can. My cell phone number is 602-859-5458. Once again, it's 602-859-5458. Or shoot me an email. It's Zach, Z-A-C-H, at zhmultifamily.com. You can check our portfolio out on zhmultifamily.com.
Awesome. Again, thank you so much, Zach, for being here. Looking forward to continue to follow you and having you on a future episode as you continue to close more deals.
Thanks, Dan. Appreciate it.